Seller's discretionary earnings versus the EBITDA, or earnings before taxes, depreciation, and amortization. Which one should you use when looking at a business? They're different, and size matters in this calculation or when you're looking at these two. So if you're a buyer and seller, stick around because we're going to discuss not only the differences between the two, but the differences in the multiples applied to them when figuring out or calculating an enterprise value. If you've got a question as we go through this presentation, please feel free to drop it in the comments section below or simply just send me an email and I'll get back to you as soon as I can. In addition, if you get something out of this episode and you're not a subscriber, please feel free to hit that like and subscribe button. And with that, let's talk about the differences between seller's discretionary cash flow and EBITDA, when you would use one versus the other, and then what drives the multiples associated with each. So before we get to that, let's back up to a 50,000 foot level and talk about risk. Because multiples, and whether it's on an SDE or a EBITDA, are really a reflection of the risk associated with the transaction. And size matters. So the larger the cash flow, generally speaking, reduces the risk in the transaction. And with a lowered risk profile, you usually get a higher multiple. But let's dive into an example. Let's talk about a couple of the characteristics of both seller's discretionary earnings and an EBITDA before we get into this next example. Now, seller's discretionary earnings is really the cash flow measurement that is used for an owner-operator company. So that is where the owner is acting as the general manager, president, the driving force behind that company. And it is usually where the cash flow of the company is less than $750,000. Now, an EBITDA is usually considered when you have a company that's got a turnkey management in place, or that the president of the company's salary is included as an expense in the EBITDA calculation or that cash flow calculation. And really, it's turnkey management, a larger corporation with revenues probably above $5 million on up, with a pretty good infrastructure in place. And the more significant that cash flow, remember, the less the risk and the increase in multiples. So let's walk through an example of how you would calculate an EBITDA and a seller's discretionary cash flow. In this example, you've got sales of $14.8 million, cost of goods sold $12.9, gross profit of $1.9 million, operational expense of $1.168 million, or net earnings before taxes of $747,852. Now to that, you add the interest and amortization expense, and that'll give you an unadjusted EBITDA of $778,000. Now the next section below that is really if you've got non-recurring business expense, interest income from, say, savings that are associated with the balance sheet, non-operational income, or personal property, meals and vehicles that are taken that are not business related. In this example, we didn't have any, so the normalized EBITDA for this year for this company was $778,000. Now, to calculate the seller's discretionary cash flow, to the normalized EBITDA, we simply add the owner's benefit. And in this case, the owner's compensation was $199,730, and the payroll taxes that were paid by the company, their responsibility, were $15,978,000, giving you total owner's compensation and benefits of $215,000, or a seller's discretionary earnings of $994,000. Now, what do you do with all of this? Obviously, this is one of those situations where it's a tweener. It's simply got to make your decision as to, is this an EBITDA calculation or a seller's discretionary cash flow? What drives or influences the size of a multiple, either associated with SDE and or EBITDA? Well, the answer is pretty easy, and it is the size of the cash flow. The larger the cash flow, the less risk associated with the transaction or the enterprise, and the higher the multiple or rate of return. Other things that can influence it are infrastructure, industry-specific businesses. If you're a construction company versus a high-tech company, those will both traditionally carry different ranges of multiples. And then historic trends, things like revenue. Are you growing your revenue year over year, or is it non-lineal, i.e. lumpy, year over year for the last 3 or 4 years? Gross margins, are they consistent? Are they growing? Are they decreasing? A word of caution, decreasing gross margins, you usually have to do with either costs of goods going up faster than you're able to raise prices and or increased competition in the marketplace. Operating costs, net profit, again, taking a look at that net profit over a historical basis or trend will give you an idea as whether net profits are consistent, going up, going down, or inconsistent over a period of time. Working capital requirements are another thing that a lot of investors will look at. If you've got a business that has a tremendous amount of working capital required to operate the business, it may have a lower multiple associated with it versus another company that doesn't. And then again, EBITDA and seller's discretionary earning, just that trend analysis over a period of time, staying consistent, going up, or inconsistent. So those are just some of the things that drive a multiple for a value. Now let's take a look at a 4-year history on a company and the corresponding EBITDA and valuation. So this is an actual company that I'm working with currently out of state. And it's a construction company with a small service base associated with it. Now let's take a look at the 4-year trend analysis to take a look at revenue, gross profit, EBITDA, and seller's discretionary cash flow. As you can see, revenue has been declining over the last 3 years, year over year, but looks like it's probably going to bounce back in 2024. The associated gross margins are a little inconsistent. The net earnings before taxes also inconsistent, but are reflective of the gross margins that are in the business. And then the normalized EBITDA is kind of up and down. Obviously, 2022 had a big job or a very profitable job and was able to drop that to the line. And then the seller's discretionary earnings, you can see the owner's compensation has been added back, and it just is really a reflection of the EBITDA plus that compensation at a pretty even level. So in this instance, when I take a look at the trend analysis mapped out like this, I'm going to use the EBITDA to calculate value, and the inconsistencies in the cash flow, revenue, and gross margins be reflected in the multiple that I choose to apply to this valuation. So the next step in calculating the enterprise value for the company is to determine the EBITDA, or the benefit stream that you're going to use, and multiply by a multiple to come up with that value. Now in this case, looking at the EBITDA, the inconsistencies over the years kind of up and down, I've decided that the best representation for the future cash flow of the company is to use just a straight average, which comes out to be $956,416. And again, looking at the characteristics of the EBITDA, the company, the revenue, and the segment that it's in, I'm going to use revenue multiple of 4.5 to calculate the enterprise value, which would be $4,303,872. Let's use some comparable market data to see how that 4.5 multiple reflects past closed transactions in 2023. And to do that, I'm using the Pepperdine University's Capital Markets Research Report that's published every year. It is widely used by valuators and merger and acquisition advisors. Now, if you take a look at the chart, you could see that there's some pretty big spreads in EBITDA. In the first column, you have $0 to $999,000, and it goes up from $1 million to $5 million, and then 5 to 10, and then so forth and so on. And if you look at the second line down, we've got construction and engineering. And for an EBITDA between 0 and $1 million, they have an average of 4. And for the next column over, for 1 to 5 million, you've got a 5 multiple. So I feel pretty comfortable using a 4.5 multiple and comparing it to the marketplace to establish the valuation of this company. And again, knowing the details that I do of this company allows me to, as a valuator or merger and acquisition advisor, to actually influence how I think the risk associated with this individual company should be reflected in the multiple. So far, we've been talking about pretty much EBITDA and the multiple of EBITDA to calculated enterprise value. But let's switch over and talk about seller's discretionary earnings. And the primary reason that you've got a SDE, again, size of the cash flow is one of the big drivers, but is usually an owner-operated business. So you're the owner-operator of a business. A financial buyer will be buying your company to replace you, take your job, pay themselves a salary, pay for acquisition financing, as well as get a return on all of that profitability on a yearly basis. So those are the things that drive a multiple. Again, size matters. So let's take a look at this next example on a transaction that I closed this last year here in Oregon. Let's review the transactional structure. The seller's discretionary earnings was $197,000. It had a multiple of 2.53 or 500,000. Borrower was putting 10% down and financing $450,000 at 8% over 10 years with a principal and interest payment of $5,459 with an owner's compensation of $60,000. In essence, they were going to pay themselves $60,000 a year plus the profit from the company. So let's take a look at the actual numbers to see how they can justify a multiple of 2.53 on basically a $200,000 a year seller's discretionary cash flow. This slide will walk you through how to calculate the debt service coverage ratio using the purchase price of $500,000, the SBA monthly payment of $5,459, the owner's compensation of $5,000, giving you a total expense of $10,459 for acquisition financing and owner's compensation. You take that away from the monthly gross net profit, or the SDE, divided by 12 of $16,444, and you come up with a net profit after those two expenses of roughly $6,000. So when you divide the 10,000 into the 16, it'll go in 1.57 times, or a ratio of 1.57 to 1, which any SBA lender would be more than happy to do this transaction, and shows you how you can justify the purchase price and the multiple based on the seller's discretionary earnings. And again, this was an SDE of about $200,000 and a multiple of SDE of 2.5. Obviously different than using an EBITDA, because you're looking at putting in owner's compensation, and that owner's compensation has a tendency to eat up the profitability of the SDE versus how you would use EBITDA, where your salary and compensation is in it. So again, size matters, and it drives how people look at value, how lenders look at value, and how you as a buyer or seller should also look at value. SDE versus EBITDA. How to calculate them, why they're different, and why each one of them carry a different range of multiples associated with the SDE or the EBITDA. Remember, size matters, industry matters. Trend analysis should be something you really take a look at over a 3 to 5 year period, as well as understanding the industry and some of the other nuances: infrastructure, customer concentration, gross margin, working capital, and things of that nature. So there are a lot of influences that will drive a multiple, and to pick the proper one, you got to do a deep dive. I hope this helps on the difference between the two and the multiples. And if you got something out of this episode, please feel free to hit like and subscribe. And with that, I'll see you in the next episode.